Hello everybody, welcome to SmartWin YouTube channel. What is Forex? Foreign exchange, FX or currency trading. It is a decentralized global market where all the world's currencies trade with each other. It is the largest liquid market in the world. The liquidity, more buyers and sellers, and competitive pricing, the spread is very small between bid and ask price, available in this market are great. With the irregularity in the performance in other markets, the growth of Forex trading, investing and management is an upward trajectory. The foreign exchange market, also known as Forex or FX, is the global marketplace for trading currencies and currency derivatives. Forex trading is the exchange of currencies. In simple terms, it is the buying and selling of one currency for another. Forex is the largest and most liquid financial market in the world, with an average daily turnover of $7.5 trillion as of 2022. Every day, many currency conversions are made both for private and commercial needs. For example, you exchange your travel funds for an overseas holiday, or a corporation exchanges currencies to pay for goods purchased or sold in another country. It can also be used for hedging existing open investments in other currencies, with the idea of reducing potential losses by opening one or multiple Forex trades that offset or even eradicate risk. Trading Forex can also enable individuals to speculate on specific price movements of one currency against another. Within a Forex pair, you have the base currency and the quoted currency, e.g., euro to US dollar. When you trade Forex, you're looking at how much of the quoted currency, listed to the right of the slash, you need to buy 1 unit of the base currency, listed to the left of the slash. Why trade Forex? So, why trade Forex? There are many reasons to trade in Forex. If we ask 4 different people, you might get more than 4 different answers. Primarily, making money is the most frequently cited reason for why trade Forex. 1. Great for short-term opportunities. As the Forex market is so vast, it's constantly offering new opportunities. In fact, most Forex trades are held for just a few hours or days. 2. It's open 24/5. FX markets are open from 5 p.m. Eastern Standard Time Sunday to 5 p.m. Eastern Standard Time Friday. This is because the different time zones of the Forex trading centers, London, New York, Sydney, and Tokyo, mean that at least one is always open. When New York closes, Sydney opens. Forex market never sleeps. The Forex market works 24 hours and 5.5 days a week. Because governments, corporates, and private individuals who require currency exchange services are spread around the world, so trading on the Forex market never stops. Activity on the Forex market follows the sun around the world, so right from the Monday morning opening in Australia to the afternoon close in New York. At any point of the day, you can find an active pair to trade. What is high liquidity? Means the ease with which a market can be traded without affecting its price. A market with lots of buyers and sellers at any given time is said to be highly liquid because you'd be able to find a counterparty to buy or sell it easily. If there are very few people interested in an asset, then it is illiquid. The size of Forex market is enormous and liquid by nature. High liquidity means a trader can trade with any type of currency. Timing is not a constraint as well. Trading can be done as per your convenience. The buyers and sellers across the world accept different types of currencies. In addition, Forex market is active 24 hours a day and is closed only on the weekends. Long or short. A trader in Forex can trade both ways. It means a Forex trader can play the market and make profits irrespective of whether market is going up, down, or is in tight range. So irrespective of the event that has triggered the movement, Forex traders do not care. Going long is a popular industry term used to describe the act of buying. On the flip side, going short is a term investors and traders use to describe the act of selling. Traders will go long when they expect that the price of the asset will rise. Alternatively, they go short when they expect that the price will fall. What is leverage? Leverage is the mechanism by which a trader can take position much larger than the initial investment. Leverage is one more reason why you should trade in Forex. Few currency traders realize the advantage of financial leverage available to them. For example, if you are trading in equity market, the maximum leverage a stockbroker is offered is 1:2, but in case of Forex market, you will get a leverage up to 150, and in many parts of the world even higher leverage is available. For this reason, it is not hard to see that why Forex trading is so popular. What is accessibility? Getting started as a currency trader would not cost a ton of money, especially when compared to trading stocks, option, or future market. We have online Forex brokers offering mini or micro trading accounts that let you open a trading account with a minimum account deposit of $25. This allows an average individual with very less trading capital to open a Forex trading account. Who trades Forex? The Forex market is enormous in size and is the largest market with millions of participants. Hundreds of thousands of individuals, like us, money exchangers, to banks, to hedge fund managers, everybody participates in the Forex market. A few decades ago, the main participants in the Forex market were the commercial banks that took positions against other banks for a wide variety of reasons, speculation, hedging, etc., and firms, exporters and importers of goods and services, would use banks for their foreign exchange transactions. All this activity accounted for about 70% of the overall volume generated in Forex. These days, however, the market has changed. With new technological developments and the ability to conduct transactions overseas with more ease, other institutions are able to participate, as well as individual investors and traders. These days speculation accounts for more than 95% of overall daily activity, meaning that most of the participants buying a currency have no intention of receiving that particular currency. These transactions are conducted from commercial banks to individual traders. The main participants in Forex are banks, central banks, commercial companies, hedge funds, and retail traders, and the main reasons they participate in the Forex market are: profit from fluctuations in currency pairs, speculating; protection from fluctuating currency pairs, derived from trading goods and services, hedging; profit from rollover generated by differences in interest rates. 7. The most important central banks are: 1. The Federal Reserve, U.S. Central Bank. 2. The Bank of Japan. 3. The Bank of England. 4. The Bank of Canada. 5. The Swiss National Bank. 6. The European Central Bank. 7. The Reserve Bank of Australia. When can you trade Forex? Forex market is open 24 hours a day and 5 days a week. However, it does not mean it is always active. Let us check what a 24-hour day in the Forex world looks like. The Forex market is divided into 4 major trading sessions: the Sydney session, the Tokyo session, the London session, and the New York session. The Forex market is open 24 hours a day from 5 p.m. Sunday to 4 p.m. Friday, due to differing time zones throughout the world. This offers many trading opportunities. However, certain periods of the day have higher volatility, such as the 8 a.m. to noon crossover of the New York and London exchanges. Thank you for watching.